Every so often I like to have a general purpose class where I go over multiple different topics in one class. I'm just going to look at a bunch of charts and show you and teach some of the concepts that I use. Here's the euro dollar. You can see it made an absolutely huge move up yesterday, and in fact it went way above our upper containment bands, which most of the time contain price. You can see the low of the day was contained and it broke through the top. Today it was totally contained. Usually after a big move, the next day might be a continuation, but more often than not it tends to be a choppy sideways day. And if the market does make a higher high the next day, usually you can fade the trend, which means go against it. In other words, look to sell it at the upper containment bands or at the next fib target. For example, this move from here to here, you draw your fibs. Notice it went to the next fib target. You went short right there at that level, pulled back from 89 to 71, pulled back 18 pips, shorted again up here, 92, pulled all the way back to 44. Almost 50 pips. Also, it's very important to look at multiple time frames when trading. I have 4 monitors. It's impossible to show all my screens on a chart, but one of the things that's nice about our software is that we have multiple different layers to show and hide charts. If you want to chart a bunch of charts to disappear, you turn the layer off. If you want to see them again, you put it back on. And so you can have longer term charts up on a different monitor and take a look at it each day to find out if there's any likely possibilities of trades. Looking at the daily chart, you can see the euro trend was down, but it kind of went up, kind of pulled back right here, found support at the 50-day moving average, the yellow line, tried to make a higher high and broke out, had multiple days down. Yesterday I considered doing a class on trend line breaks. You have a beautiful trend line here that when it got broken exploded up. So as long as it kind of is going sideways right here today, has the potential of making a higher high. It's very unlikely if it had shot up today to go above the fib target of this. So 32.25 would have been the likely max high of the day, especially since the longer term trend's down. It's more likely to find resistance at the first target, fib target versus the second. But also notice on the daily chart we have, the 10-day moving average up here at 1.3180. And where was today's high? 31.96. It only went 16 pips above that level. And because yesterday is such a big trend day up, and because the longer term trend is down, looking for sells up here at the high, especially when it hit the fib target, it was a pretty high probability trade. Again, when you draw your fibs on this wave right here, and it goes to that area and stalls, you might have shorted here with a small win, and then the second trade was a very decent one. When it's going sideways like this, you want to generally avoid any kind of trades. Wait for it to go above the high here to buy. Remember, it's not likely to go above the upper containment band, or if it goes below the sideways rectangle low, you want to short it. This is your first profit target. So it's a good number of pips away, and it makes it worth taking a trade. Always look at where the next support resistance is, and if it's 20 pips away and your stop is 10 pips, you're going to lose 10 pips if wrong. And keep in mind that as currencies are moving your way, your 10 pip stop moves up or down with it if you're long or short. And so you might only lose 6 pips even though your initial stop is 10. But you use your initial stop as your loss if the trade doesn't work, even though a lot of times you don't lose that initial total amount. And then if the profit target's double that, you take the trade. If it's if you think it's 50% or more likely to happen, and it's likely to give you 20 or 30 pips, if you're right and only take 10 pips from you if you're wrong, you pull the trigger. And new traders should really keep that 2-to-1 ratio. Experienced traders and myself, I generally will take a trade that will give me 15 pips with maybe 55-60% chance, even though my stop is 10 pips. Let's look at some of the charts to spot some trades. This one also made a big move up, and again, after a big day, usually you get some choppiness, and if it does go up, it's usually a pretty high probability place to look for counter trend trades. But earlier in the day, we have the previous day's high right here, which acts as resistance. And when the previous day's high is hit, and the market doesn't even pull back to the hourly moving average, In this case, it actually looks like it came close to it. But usually if the market explodes up like this and goes sideways, in this case, the hourly moving average got yanked up to it, but it never really pulled back and had a decent pullback. Usually if you get a big move up and it goes sideways like this, when it does break out, you're very likely to have a profitable trade, and you want to wait for it to go above the high right here. You go long, maybe 10 pips stop, and then it exploded up. And this is where the range chart really comes into handiness. On a range chart, you see this nice breakout right here, and if you wanted to, you really could get into the trade when it breaks out here, have your stop right here. You might have lost 4 or 5 or 6 pips on that, and when it goes back above this area right here, you go long again, and you also have the fib targets of this little wave here. I would exit half my trade here, and then the other half up here. So 51 out of half, 37 out of half. Let's just say the average exit's around 44. We're in this trade around 20. We made 24 pips while risking less than 10 pips. On a range chart, you're risking the number of pips per bar. In this case, 6. Each of these bars is 6 pips unless there's news. If there's news that comes out and the next price point is 20 pips up, then we show the bars 20 pips. But the majority of these bars are 6 pips, and you can tell when they're all the same size. You put your stop just 1 or 2 pips underneath the low, so you're always risking less than 10 pips. And this was your profit target up here at 37. You're likely to make 17 pips while risking 8 to 10 pips. It makes it worth the while. And you can see the daily trend's up, the weekly trend's up, the monthly trend's up. Yesterday it exploded up. It's kind of been going sideways without a whole lot of weakness. Anything at and underneath the 80 level, or I should say anything underneath the 80 level is not that strong nor weak. So this was the first amount of strength, and that it continued. Here, this is one of the signals that I look for, and we have many classes on this. Trend reversal signals using the 3 and 4 hour time frame bar. These are usually the end of the move, and sometimes they reverse immediately. If it had come down underneath the previous day's high right here, you're likely to get a big move down. And in this case, it shot up one more time, went up to my Fibonacci profit target and Fibonacci retracement level. Very high probability place to look for shorts up there. And in fact, I probably would have sold right here and lost, and then drew my fibs on this next wave up and got in a short right here, and probably made about 20 pips on that trade up there. But before, you can always, if the currency's underneath the upper white band and is showing lots of strength, the daily, weekly, monthly trends up, these signals don't always reverse immediately. I mean, I honestly would probably have sold it right here. The fact that it came down and found support at a weekly pivot level and the previous day's high. And this is one of the reasons why we have that rule. Try not to take a trade that doesn't give you at least 2 times more profit than your risk is. This is one of those reasons why. Your profit target's only about 10 pips down. You're risking 10 pips. It doesn't make sense to pull the trigger on that. I believe in the signal, so I would have taken that trade anyway. But when the trade doesn't pull back like that, the initial stop is right above the high. When the market's kind of going down here and then it comes against you, when it comes back down again, you really want to put your stop right here. So you lose 5, 6 pips on there, you flip and go long, and because of this counter trend signal, you're not expecting a super huge move. So I personally would have got out of this trade right here. I might have also gone short again, got stopped out, and then waited for it to hit the fib target. All right. I usually, myself personally, scale into a trade. I might, for example's sake, I trade sometimes 10 to 35 full lots at a time. But for example's sake, I'm going to say the first entry, let's say you got into a lot here. When it hits the second fib target, when it's way above the upper band here, after one of these signals, I will put a 2 lot or a 3 lot trade on. So you have 4 lots, your average price is somewhere up in here. And when it pulls back, typically these strong trends, you may get a 2-wave pullback, you may not. I tend to, when I have scale-in trades like that, I just tend to get out when it goes sideways at 38. But you can see it move down 20 pips. Here's another currency where the daily, weekly, monthly trends up. My Fibonacci analysis that I do each night. Anytime a currency breaks out from above or below to above the upper previous day's high and pulls back and finds support there, it's very high probability trade right here. I would have exited right here. One of our systems is when you have a rectangle pattern after a strong trend, the minimum is 30 minutes, usually 2 hours or more is a very high probability trade. You go long, and then you draw your fibs on there. And this is, again, when the market's above the upper containment band, it's already gone up. It's gone up again. I tend to exit my trades right here and also do a little counter trend trade, make 10, 15 pips on the way down. The fact that the market, again, did not pull back down to the hourly is a very high probability sign that it's going to go up again. So when it finally breaks out of this kind of flat bottom wedge pattern, I would go long again. As soon as I see this pattern right here, I'm a little bit nervous. So whenever the trailing stop gets hit, I'm out, and that got hit right here. And I would be short from there as well, because this signal is a very high probability counter trend trade. My stop would be right above the high. If I'm ever short and it's just going sideways like this, usually I will exit within 30 minutes. If it doesn't go my way within 30 minutes, I'm out, because again, I'm trading against the trend. Being a Friday today, it's a lower odds trade. The volatility dries up in Friday afternoon, so it could very likely go sideways. This one, the trend's down. And again, after a big day, typically you have sideways. Usually you can buy the lows, just like we saw the opposite of selling the highs in the other currencies. But when they come up to the hourly, that's usually a pretty decent place to sell. I'll usually sell the first time it hits the hourly, and then sometimes the second, but never the third or fourth, because usually if it's not going to go down, it's going to shoot up. Again, big move down, very choppy day. In fact, this is a good example of our false breakouts. Here's the previous day's low. It found support. When it broke down underneath there and goes back up, I tend to get into those trades. I would have had a very small win or break even right here. And then later on it comes back down again and breaks out right here. And you can see the trailing stop gets you out of the trade here at 74. I tend to exit half when the market stalls. So I would have been out of half my trade at 67, the other half at 74. So the average price may be 70. In this at around 56. So it's a 14 pip win while risking about 10 pips. After a big down day like this, I don't usually expect further continuation. Here's my Fibonacci profit target in play. Again, the previous day's high got broke, came down and did a retest here. These are when currencies break out and then they find support at the previous day's high, or if the opposite case, find resistance at the previous day's low. It's a pretty high probability place to get in. I probably would have got out as it went sideways right here. You buy this next breakout, and again, the Fibonacci profit target's likely the max high. That's where it is. It went up here with a lot of strength, and then the strength fell out. So this is a pretty high probability place to sell. 67, you can see it came right back to the hourly at 41. 26 pip counter trend move there. And most of the time, the upper containment bands contain price. When the Fibonacci profit target level happens to be there as well, when you see the strength die out like that, typically reverses. When it's strong currency that's above, the hourly moving average, kind of goes sideways at the hourly, and then later on in the day breaks down and makes, starts to go lower below the choppy sideways action, the rectangle pattern low. Pretty high probability trade. You can see it pulled back nicely there.